Hello friends. Last week the markets edged higher and the bulls overcame walls of worry. Third week in a row the markets have risen. And in this video we are going to take a look at how sustainable the upthrust is. On your screen now is the market roundup window, which tells you that it was the Nifty which led the rally, and the broader base Nifty, of course, is good news that this index led the upthrust. Bank Nifty followed suit, and the US dollar index gained 75 basis points, but in spite of that, our markets have overcome this worry to kind of go higher. Crude oil and natural gas were subdued, and that was very good news because lower oil prices are something that will cheer our markets. Gold gained a little bit, whereas silver fell, and what we are seeing is the Indian 10-year benchmark bond yield eased 4 basis points, which means bond prices went up, which is what explains the Bank Nifty's resilience. MWPL continued to rise, which is along expected lines, and where the US market indices are concerned, the Dow Jones Industrial Average fell a tad, but the Nasdaq and S&P 500, which both these indices are relatively broader than the Dow, gained. On your screen now is the daily chart of the US Dow Jones Industrial Average. What you are seeing is that the death cross remains in place. The 50-day moving average remains below the 200-day moving average, but to be fair, turning higher. Price is above the first inflection point of 31,886, but is unable to go past the previous swing high of 33,272. That is approximately where even the 200-day moving average is. So that's like a dual pressure point. Let's wait and watch and see whether this resistance is overcome. Now for the Nasdaq 100, relatively speaking, a far stronger chart as compared to the Dow Jones Industrial Average. Death cross remains in place. 25-day moving average climbing higher. Price is marginally below the 200-day moving average, although the previous swing high of 12,898 is overcome. This is good news for our Indian technology stocks as well. The S&P 500 is almost at kissing distance away from its previous swing high of 4,178, which also doubles up as a 200-day moving average. The death cross remains in place. The 25-day exponential moving average climbing higher. And here again, we are awaiting a confirmed breakout before you could see any further optimism coming in. Returning back to our domestic markets indicators, on your screen is your weekly MWPL, market-wide position limit chart. And this is nothing but the exposure limits utilized by traders as compared to a component of the total exposure allowed by SEBI. Last week, I pointed out to you that the MWPL, which happens to collapse every 4 weeks, which is an expiry-based phenomena, of course, has bottomed out at 21.48%, which is significantly higher than the last 4 expiries. That's a positive indicator. And what you are seeing is in the week gone by, the week immediately after expiry, the MWPL has bounced to 27.16%. In the last 4 expiries, this has never happened. In the week after expiry, MWPL is in its mid 23%. Only in the month of March after expiry, you saw 25.53%. But this at 27.16 is a sign that 2 marshmallow traders are expanding their risk appetite. That's a green flag as far as I'm concerned. Now let's take a look at the individual stock futures versus the index futures turnover. Stock futures turnover still remains down, whereas index futures turnover continued to rise on a week-on-week basis, although by a small amount. What it tells me is that 2 marshmallow traders, guys who roll over their trades to the next day, are showing higher risk appetite, but one marshmallow traders, the intraday traders, are showing lower risk appetite. What could it mean? It means that day traders are probably, I'm using the word probably here, are probably unable to make significant amounts of trading profits. It's the buy and hold guy who seems to be making a little more money than the intraday guys, which is what explains the lower turnover here. Now for the basis. Basis is nothing but the premium enjoyed by futures over spot. The Bank Nifty and Nifty basis both show basis contraction on a week-on-week basis. And that's not really surprising as you head into the derivative cycle. Basis does tend to kind of erode. It is like the options premium. There is a time-wise decay. And so far, so good, the basis is above zero. It is when inversion or fall below zero into discount territory occurs that a trader should begin to worry. So right now the basis is indicating that at higher levels there is caution, which is fine. I told you last week that weaker hands who don't trust this rally will endeavor to go get out of their long positions. That has happened. Now, for the advanced decline ratio, this is a leading indicator of one marshmallow risk appetite, and this has stayed above the 1 level, which means the bulls have remained in control for 7th week in a row. Although on a week-on-week basis, we are seeing the advanced decline ratio ease to 1.28. Last week it was 1.99, but staying above 1 is also a green flag. Now for the impetus chart, this is something you've learned to trust, bank on for over a year and a half now almost. What you are seeing is that for a change, the Nifty impetus has gone up. Last week, the Nifty impetus fell where the Bank Nifty impetus rose, but now the roles have suddenly reversed. The Nifty has risen on a week-on-week basis by 1.39% and the impetus has really shot up. It's now in the upper end of the 20-week range, whereas the Bank Nifty has eased, which tells me that there could be some profit taking possible on the Bank Nifty at higher levels. Now for the LWTD, the lift weight thrust drag indicator of the Nifty, what you are seeing is that the percentage gain loss line, the blue line, has eased off to 0.09, marginally above zero, but the LWTD has stayed below zero for the 5th week in a row. It's marginally below zero. So what does it tell you? It tells you that there could be some amount of profit taking at higher levels. Optimism remains. The Nifty percentage gain loss line remains above zero. So upsides are still possible, but there's a little bit of overhang of profit sales. Now for the footprint of the 4 market participants, I start with the FIIs who've reduced their index net long positions marginally, but raised their stock long positions in futures marginally again. Where DIIs are concerned, they've cut their stock futures shorts significantly and they have raised their index net short positions to 6,000 lots here. Prop traders, these are brokers own trades, very savvy guys. They know who's buying, selling, how much, so they're second best to insiders. They've raised their individual stock futures net long positions marginally by a little over 600 lots and cut their index net short positions substantially, almost by half. So they are taking a very cautious but optimistic approach. Now for the retail traders, these guys have been doing all the heavy lifting since the lockdown started in 2020, and their individual stock net long positions in futures is at a multi-month low. They are basically exiting from their long positions as the indices edge higher. Where their index futures are concerned, they were net short in the prior week, but they are now back into net long positions, marginal 1,757 lots only. So the picture is indicating that it's an institutional market. The retail guys, along with the prop traders, are going cautiously. It's the institutions which have majority of the say, especially in the spot segment. Friends, I now come to the bond market, and after the RBI governor raised repo rates by 50 basis points or half a percentage point, cost of funds have gone up. It was actually necessary. I've recorded a video on Friday itself about how the rise in interest rates is actually a silver lining. Do watch that video, please. Now, on your chart, on your screen is a chart, weekly chart of the Indian 10-year benchmark bond yields. It tells you that bond yields resisted a very big decline because of the hammer that you are seeing on your chart. But last week, I told you that the 7.20, 7.25 level was no more indefensible Maginot line. So that was breached. This is exactly why I have been maintaining on my social media accounts and in my videos that you should resort to laddering. Do not wait for an ultimate round number before you start investing in the sovereign. I've made that mistake in 2013. I waited for a round number of 10% yield, missed it very badly, and lessons learned. No problem. I will be alerting you on my social media accounts when I do feel that yields do appear to hit a bottom and are likely to rise. So do monitor the bond market extremely carefully. It is closely linked to the prospects of the USD INR. So both will have a pull-push impact. And let nobody tell you that the bond market is not important enough to watch, even though you're an equity trader. Particularly if you're a bank Nifty trader, please do not take your eyes off the 10-year benchmark bond yields. Friends, the bond market done, I now come to the US dollar index, extremely critical for emerging markets, including India, because we are import dependent and any and everything that we import is dependent on the US dollar. So if the dollar becomes strong, we basically find the landed cost of imported goods going higher, resulting in imported inflation. So the US dollar index gained 75 basis points, as you can see on the daily chart on your screen. It rose on 3 out of 5 trading sessions. The closing is above its 25-day exponential moving average, which means the short-term outlook remains optimistic as of now. Trading sustainably above the 107.25 levels should bring the bulls back in the driver's seat. The weekly chart on your screen tells you that it was a bullish engulfing pattern where the green candle is completely engulfing the prior red candle, which means the bulls overcame the bears forcefully. The price remains above its 25-week exponential moving average, which is a 6-month long holding on cost of an average bull. So the medium-term outlook remains optimistic, but the difference between the price and the moving average tells me that corrections may not be over completely. Friends, last week I advocated a range between 107.65 on the upside and 104.05 on the downside, which held perfectly well. In the coming week, I expect a range between 108.40 on the upside and 104.75 on the downside. Do keep an eye on this index. Friends, I now come to the Bank Nifty, which gained 1.14% on a week-on-week basis after logging gains on 3 out of 5 trading sessions. As you can see on your chart, what we are seeing is that the price is far above its 25-day exponential moving average. Although that means the short-term outlook remains optimistic as of now, but it also calls for some amount of profit taking as a probability. A small kind of a trailer is something that you saw on Thursday, as the big red candle tells you. Now, between the two indices, the Bank Nifty is the first one to break out above its downward sloping bearish trend line, which started in October 2021. Now, its doorway to the previous swing high, the major swing high at 38,759 has opened up. And in case of declines, I expect the 36,084 level to be defended very, very aggressively. Now, that's of course a little too far down, but the immediate support will be both at the red trend line, downward sloping trend line, and the 25-day exponential moving average, which is closer to 36,500 odd levels. The weekly chart is a little more intriguing. Intriguing in the sense because it's extremely interesting. A couple of observations that I made on this weekly chart. Number one, the market has rallied for 3 weeks in a row. It's never done that after December 2021. So to that extent, the bulls are attempting to fight back. But the second aspect is every candle in the last 3 weeks is progressively smaller than the previous one, which means that the bulls are pushing up, but their efforts are yielding smaller and smaller results. Although that is expected, because at higher levels you were expecting mean reversion. Do see how the price is far above its 25-week exponential moving average, which is a 6-month holding on cost of an average bull, and that moving average itself is turning upwards. So the weaker hands are expected to nervously get out of their long positions. Extremely expected. And what it means is there could be a churn for the next couple of weeks, and should we break out above the previous significant high at 38,759, you're going to see the bulls coming back in undisputedly in the driver's seat. Friends, in the week before last, this index was number 5 on our most volatile counters list that we maintain in-house. It remained there. It maintained its number 5 position, which is a mercy because excessive volatility does not help a retail trader. Last week, I advocated a range between 39,125 on the upside and 35,875 on the downside, which held perfectly well. In the coming week, I expect a range between 39,500 on the upside and 36,350 on the downside. Friends, the Bank Nifty done. I now come to the Nifty 50, the most liquid traded instrument in the derivative segment in the NSE, which gained 1.39% on a week-on-week basis and gained on 4 out of 5 trading sessions last week. What you can see on the daily chart is that the price is far above its 25-day exponential moving average, which tells me that mean reversion could be a possibility. We could head towards the moving average as a support. Unlike the Bank Nifty, which has broken out above its downward sloping trend line, the Nifty 50 is still to do so. So to that extent, it still needs to prove itself on the daily chart. As long as the bulls maintain the level above the 16,794, which is the previous swing high, I think they still remain in control, and the 17,800 level is where the red color bearish trend line is, where you could see some amount of profit taking emerge. The closer it gets towards the red trend line, the higher will be the volatility that you will see on this index. Now coming to the weekly chart, here again what I'm seeing is that the Nifty has risen for 3 consecutive weeks. So after a span of 7 months, you're seeing the bulls pushing through. The price is above its 25-week exponential moving average, which is a 6-month holding on cost of an average bull. The average itself has turned higher, just as it had in the case of the Bank Nifty. We could see some amount of profit taking for the simple reason that here again, the size of the bullish candles is growing smaller, which means the bulls are appearing a little labored. Though not necessary, it's a possibility. In the week before last, this index was at number 11 on our most volatile counters list in-house. It remained there, maintained a status quo, which is good. Last week, I advocated a range between 17,775 on the upside and 16,525 on the downside, which held perfectly well. In the coming week, I expect a range of 18,000 round figure on the upside and 16,800 on the downside. Do exercise abundant caution, keep stop losses and trade light because I expect volatility to be higher. Friends, the index done. I now come to the risk appetite of the retail trader due to its exposure component. What you are seeing on your screen is the percentage turnover contributed by the index options versus index futures and stock options and stock futures. What you can see is that the olive green line, which indicates the stock futures turnover, is down on a week-on-week basis. What it means is that the retail trader has resorted more to individual stock options as compared to stock futures because options are relatively cheaper to trade. No span margin, no mark to market, you just pay the premium. This, of course, is a perception, but it tells me that the retail is on the back foot. Do remember, I showed you the retail footprint by way of the futures exposure. It has come down to multi-month lows. So being an institutional market, retail is on the back foot. A small, very small red flag, which is why I told you that the indices might just see a little bit of mean reversion because the prices are far away from its moving averages. Now, friends, for a popular segment of our video for statistical traders who build statistical models. I give you 5 stocks which are impetus gainers, where you take small exposure, wait for large price moves, and 5 stocks which are lowest on the impetus rankings on a day-on-day basis, where you take big exposure, wait for small price moves. The direction, of course, your snapquote window will tell you on your trading terminal as per your statistical model. So the list of high impetus gainers is led by Indus Tower at number 1, AU Bank at number 2, Escorts at number 3, Indigo number 4, Cipla number 5. Impetus losers list led by Naveen Flooring number 1, number 2 Syngene, number 3 Sun TV, number 4 IGL, number 5 Aditya Birla Capital. Friends, I now come to a conclusion of this video. Not before reminding you to click like on this video if you liked what you saw, subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. And in the comment section, please let me know what you think about our work. I would be very glad to hear from our viewers. And help me reach out to fellow like-minded smart investors and traders like yourself by referring my video to all your friends and social media groups, etc. Friends, I wish you have a very, very profitable week ahead. Thank you for your patience. Till we meet again in my next. This is Vijay Bhambwani signing off for now. Bye-bye.